Hey, good afternoon, good evening, everyone. The market went down quite a bit today, showing that the market was expensive to begin with. I've been saying that for a couple months that I was concerned that asset prices were much too high. And on a day when I've seen a lot of good earnings reports, I'm seeing stocks sell off. So that is, in my mind, some evidence that stock prices were a little too high. We'll look at a couple of stocks today that I think, reinforce that point. Stocks like Palantir had really good earnings, but the stock was under pressure. Uber, really good earnings, stock under pressure. So we'll take a look at it. We'll see what kind of market we're dealing with. Now, the stock market, sometimes it is concealing a great opportunity. This is day one of a potential sell-off. So it's not like we have a massive correction on our hands. It could be the beginning of a correction. Most definitely can be. We don't know yet. We don't know if tomorrow the market decides, okay, we want to buy. We don't know. We'll see if the market is going to continue to sell off tomorrow and for the remainder of the week going into next week. One thing that did change from last week to this week is we don't have big trillion-dollar market cap stocks announcing this week. So there isn't a big giant company that can create a lot of enthusiasm. Last week we had two companies report really good earnings in Amazon and in Google Alphabet. They had terrific earnings. Those stocks went up, but both of those today sold off. And we had other stocks I thought provide decent earnings in the form of Microsoft and Apple. And those stocks, I think they went down a little bit, gained a little bit. And the one that really came out of the week, just limped out of last week, was Meta, that announced their earnings and told investors that they were spending a lot of capital without showing very much for it. And investors really didn't like what they heard. Now, I think what investors are thinking about is, what if this AI thing doesn't create the value that it's supposed to create? We're paying a lot for these valuations. And maybe this is a good thing. Bring down, stock prices so that stocks are more rationally priced, closer to the intrinsic value of their cash flows, more realistic in what kind of sales growth they're going to have for the next 5 years. And again, we'll see if this is the beginning of a trend or if it's just going to be a one-day sold off. We had something like this in the month of October. We had, on a Friday, we had a big sell-off, but there was no second big sell-off after that. Stocks kind of regathered themselves and then went higher from there. So we'll see where it goes. For the whole year, the S&P is doing well, up 15%. You see that, today's action was a little bit negative, but not too bad. And here's that Friday I was talking about. We had a pretty good sell-off on that day. You look at the 1 month, we're still up for the 1 month. That includes today. We have had a little bit of a sell-off here where, I guess on October 28th, we were quite a bit higher, and we've sold off a little bit since then. Now, it's going to take a lot for the market to really go bearish, but we'll see what happens. We'll see what happens. Again, we don't have any big earnings that are going to rescue us and take the market higher. And I think if the market has certainly invested in the AI story big time. Like, in some cases, these stocks have just been going up to the moon. And the same could apply for the stocks selling off. If the story becomes the theme that investors are going to invest on or trade on, which is the AI bubble could really cost investors. Stocks could continue to sell off. We shall see. Looking at the heat map for today, NVIDIA down 4%. They're still doing great for the year to date and doing awesome for the last 3 years. Broadcom was down almost 3%. AMD was down 3.7%. We're going to take a look at AMD. They announced their earnings after the market closed, so I have an update on AMD. Qualcomm was down. Palantir was down almost 8%. We'll take a look at Palantir. Palantir, the CEO, is quite colorful. And he took offense to Michael Burry shorting Palantir. And he had some colorful comments to say about Michael Burry. Michael Burry, I don't think, is looking for the CEO's approval. He's just trying to make money. And he's certainly made some good calls. But I don't know that Michael Burry's right on all occasions. He's kind of been wrong on a good number of occasions more recently. I still have a lot of respect for him. Don't get me wrong. The infrastructure behind the semiconductor space also sold off. Hardware sold off quite a bit. Google sold off. Meta sold off. It just was the big caps really took a hit. Tesla was down substantially. Tesla, I think, is going to deal with a lot of headwinds in selling cars because EV sales that were reported by Ford and Hyundai showed a big decline in EV sales in the month of October, which is the first month after the federal incentives to buy an EV ended on September 30th. So I think Tesla is probably going to announce some quarters that are going to look quite terrible. If you look at the financials, silly me, I look at financials and I look at fundamentals. That's an important part of me believing in a company, understanding a company, and investing in a company. And Tesla is going to have a hard time. Their compares are just going to be terrible if unit sales really go down. So we'll see what happens there. The energy production space or the equipment to generate electricity, it took a hit today. It's been flourishing with the expectation that just a lot more power is going to be needed. And I think the data centers are going to need more power, but I follow GEV and their revenues are not growing that much and they don't make a lot of money. Their margins are very high. So I'm not sure where the value is going to come from there. So it was a down day. And I think other spaces, consumer staples, had a decent day. Good part of healthcare had a decent day. And some parts of financials had a decent day. Of course, Berkshire is up. They have a lot of cash on hand. If stocks really sell off and there's interesting bargains out there available, Berkshire will probably take advantage of low stock prices. But we're quite a ways from saying the market is now cheap. Right now, the market's expensive. One day doesn't correct a very expensive market. So that's what's going on there. So we are in earnings season. This is, if I'm counting right, this is the third week. This is not as big as last week. Last week was huge, but this is a big week. Today, after the market closed, we had AMD. Yesterday, we had Palantir. I'll cover Palantir on this stream, as well as Shopify announced today. Uber, Arista Networks. We're going to take a look at Arista. Pfizer, Spotify. It'd be nice to look at Spot. I've been a seller of Spotify just because their valuation isn't very good. I'm looking for awesome businesses that resemble Spotify, that create a lot of profit, free cash flow, have excellent balance sheets, and they give me a great price. And I know that I can find some stocks that resemble Spotify that fit all that criteria. Spotify is just a little too expensive for this investor. We'll take a look at it. And we will look at some requests. If you're a member of the channel, you can request a stock, just put it in the chat. We'll take a look at it. We'll look at the fundamentals. We'll see what roughly it would be valued at, see if it's a stock that's in a good position within its industry and either set to flourish and stock price to go up, or maybe the opposite. It's a stock that's maybe going to have some hard times ahead. If you're not a member, just a $5 super chat and I'll take a look at your stock, or consider being a member. It's easy. I put the details in the chat if you'd like to get signed up. Looks like we've got our first comment. Shamba Basher, good evening. Hopefully you are doing well, sir. All right, so let's get into some stocks that announced. And I'm going to start with Palantir. Palantir announced yesterday, and the stock did sell off today, and it continues to sell off in after hours trading. Now, what became interesting is that Michael Burry, he's shorting Palantir. Now, that shouldn't be all that dramatic. Michael Burry is a big name. I mean, a lot of people know him as the big short guy. And the CEO said he was bat, beep, crazy. And I thought that was funny. The CEO tends to be colorful. And I see a lot of comments came in at the same time. Thank you, Shamba Basher. Let's take a look at AAFAF. And that's Airtel Africa. Yeah, you got it. That'll be interesting. Thank you, sir. And the newest member of the channel, good to see you, Osvalderod. Very good to see you. You want to look at SEZL. Let's take a look. Thanks for joining us tonight. Appreciate it. What's up, Carlos? Good to see you. Big House. Let's talk Uber. You got it. I've got Uber on the list. I'm ready to go on Uber. I listened to the earnings call. I've got a lot to say on Uber, and I'm a big stockholder. And you want to look at AXON. All right. We're off to the races. A lot of good requests. Thanks, everybody. Let me finish my thoughts on Palantir, and then we're going to get cracking on this list. We'll jump right into it. Okay, so Palantir announced their earnings, and the earnings were really impressive. We'll go over that. Now, what's holding back the stock is this stock price, right? It's up 355% over the 1 year, year to date, 152%. So when a stock appreciates that much, is there a limit? Yes, there is. There's a limit to the stock price. You know, the company that you could have bought a couple of years ago for $17 a share is worth $190 a share. Is that rational? Well, I know a lot of people believe in Palantir. I think they're really impressive based on their earnings growth. But there is such a thing as paying too much for a good thing. Let's take a look. Herdo, good to see you. Zeta announced. Let's take a look at Zeta. So did Pinterest announce. Nobody's asked about that, but we'll take a look at Pinterest. The stock was trading lower by 19% when I last looked at it. So our friends at Palantir had excellent growth. 62.79% revenue growth, top line. And they're above $1 billion in revenue. So that's really substantial growth. If you annualize that, that's $620 million of annual growth. It's really impressive. And their profit is really impressive. They're very profitable. So when we look at the fundamentals, they're really impressive, but they're just not that big. There's, I guess at this point, they're going to be about a $4 or $5 billion annual revenue company. Free cash flows there. Margins are really good at 82.45. Profit margins are there. So the fundamentals are terrific. Now, when we look at what analysts are saying, 20 analysts cover it, and they just believe the stock price just got too high. There is such a thing as a stock becomes too expensive. And even though they announced terrific earnings, it sold off. And of course, Michael Burry shorted the stock. He didn't ask anybody's permission. And that really upset the CEO. It's good to have a couple of colorful comments, from these players of the stock market once in a while. Now, Palantir has a analyst that has a price target at $255 a share, which is, substantially higher. But you also have a bear analyst at $50 a share. We look at their growth. Their growth is really impressive, and it's going to continue to grow quite well. These growth rates are really, really good, and they're going to be an $11 billion revenue company in 2028. That's very good. And their profits are going to grow. Their PE, this is where it begins to kind of tell you that it's expensive. A price to earnings ratio of 292. That is expensive. And even in 2028, when they get larger, you're still going to have to pay a PE of 116. After they grow their profits for 3 consecutive years, it's still going to be an expensive stock. And that's why I don't own Palantir. Just the valuation is surprising. It's like, wow, people are really paying up for Palantir. So for me, it's a pass. It's a stock that's too expensive. When I value the stock, I'm well below from intrinsic value of their cash flows and the intrinsic value of their future profits. I'm well below $190 per share. But the people that believe in Palantir, they've been correct. If you've been a Palantir investor for 3-4 years, you nailed it. You saw this company had something special. They've grown really well. It's not that investor's fault that so many investors loved it and bid up the stock. So it's been an awesome investment for that investor that bought into Palantir 3 years ago. Congratulations. You should really pat yourself in the back and figure out how you can go find the next Palantir, because it certainly has been an absolute winner. So congratulations to all those that own Palantir. All right, let's get cracking on this list of requests. And we're going to start with AAFAF, Airtel Africa. This one's on the London Exchange. This is over the counter. Okay, so USD. 1 year, this is up 180%. 5 year up 83%. Market cap 14 billion. So Airtel Africa, together with its subs, provides telecommunications and mobile money services in Nigeria, East Africa, Francophone Africa. It offers pre- and post-paid wireless voice, international roaming, fixed line telephony services, data services, including 4G, 5G, home broadband, fiber, data centers, mobile money services such as digital wallet payment systems, microloans, merchant savings, international and international money transfers. So they do quite a bit. It's like a telecom fintech company. Founded in 2018, so it's relatively young. It's not a company that's been around for a long time. They're headquartered in the UK, in London. Take a look at their website. Okay. Now, I imagine that in the continent of Africa, there are people that are getting a smartphone for the first time. They're getting this type of device for the first time. So this is organic growth. And the fintech as well, like the transactions using their digital finance solutions. A lot of these people are using that type of solution for the first time. So very good organic growth available in Africa is what I imagine. So they have 173 million customers. They have data centers. Interesting. They have money customers. So I imagine people are transferring money to loved ones. If somebody maybe went to work in another country and is wiring money to people back home. Okay. So interesting business. I'm sure this is a continent that needs these services and is getting a lot of value from these services. So I've got a gist of the business. I think it's a business that's going to be in demand for a long time. It looks like this company is grabbing market share, providing a lot of value. Let's see what their fundamentals look like. See if it's a business that's doing well or maybe just priced too high. So the market cap is $14 billion, revenue of $5.59 billion. So you're paying less than 3 times revenue. PE ratio this year 28.6, next year 18.5. They do pay a dividend. So I wasn't expecting that the company would not be growing, which is a surprise, considering the stock price was going up so much, but they're not growing. I'm seeing negative growth for the last 2 full completed years. Looking at the quarterly, it looks like they turned things around. They were negative and they turned things around. And for the last 4 quarters, it's been positive growth. And the growth is accelerating. The percentage of growth is increasing, which is impressive. Okay, that looks good. Profitability looks good. They are quite profitable, much more profitable than a telecom play. Telecom companies are not the most profitable companies that you'll find. Let's take a closer look, see what kind of cash flow they're generating. They're generating good amount of cash flow. The gross margins are 67. Again, for a telecom play, that's a good gross margin number. The profit is there. Operating margin is good. And free cash flow margin is very good. Okay, so the business has started to grow. The market has noticed that the growth is really impressive. The margins are good. So I'm liking what I'm seeing. The whole stock rally is very rational for this stock. So looking at their balance sheet, let's make sure that they don't have too much debt. They have $6.23 billion of debt. They have $727 million of cash. So $5.5 billion of net debt. Debt to EBITDA 2.34. That's fine. If you look at the American telcos like AT&T, Verizon, those companies have a lot of debt. So for these guys just to have 2.34 debt to EBITDA ratio, that's actually fairly good. So these telecoms have to put a lot of capital into their businesses to build out networks, to make sure they can provide the telco services that they're selling to customers. So that looks good. All right. So balance sheet's decent. We've got very good ratios. Now let's go ahead and value this company. we're going to do is we're going to value Airtel Africa, and we're going to start by comparing it to, let me think here for a second. So they're probably similar to America Mobile. I've got a few telcos out there, and these guys are not a pure play telco. They also have fintech. So I think this will be a good one to compare it. And the person who sponsored this super chat, I believe you're in the UK because you paid $10 in, I think, pounds, which is great. Thank you. I think that's a pound is more than $1. So thanks for the sponsorship. But the reason I wanted to point that out is the company we're looking at is headquartered in London. So that's in your home country, which is better for you. Like I'm in the US, so it'd be a little bit of a higher risk for me because I am in the US. So it'd be out of my home country. I'm going to go with 8.5 as the discount rate, knowing that you are investing in a company in your home country. If it was just a play for me, I'd probably go 9.5, but we're going to go 8.5 discount rate. And I'm going to update my dates here. All right. So let's take a look at the trailing 12 months of free cash flow for this company. And I'm doing my analysis in US dollars, by the way. So it'll give you a valuation in US dollars. And hopefully that's useful to you. All right. So trailing 12 months for free cash flow is $2 billion. Very good. So it's $2 billion. Now they're growing really fast in the quarterly. The last full quarter, 29%, which ended September 30th. And then 22% the quarter before, 17.9 the quarter before. It's very good growth. And when I look at the growth in free cash flow, and I'm looking at a screen you guys can't see just so I can see what kind of numbers I'm working with and try to put together a rational forecast. But the free cash flow has been growing over the last 6 quarters. Looks good. Yeah, it looks really good. So I'm going to grow cash flows in the first 4 years by 15%, years 2 through 4. And on this year here, I'm going to expect that their momentum is going to continue, and we'll grow that by 15%. So the intrinsic value is really high because this cash flow is really high. These guys are cash flowing at 2 billion. Their market cap is 14. So the yield on cash flow is really high. All right, so let's go ahead and adjust the debt because they did have some debt here. I think it was 6.5 or so, 6.23. Okay. And they had some cash, 727. Okay. Forgot to update my symbol. Yeah. So this company, their cash flows are so high that you're looking at a stock that could really go up higher because of its cash flows. If we believe these cash flows are going to keep growing, just the value of the company is going to grow. You think about it, they're just going to amass so much cash on their balance sheet. The enterprise is just going to be worth more. They're going to have a balance sheet that's worth more. So this is a nicely discounted stock. Even if I said, this is out of my home country, so I'm going to go with a higher discount rate, it still has a very substantial discount if we compare that. One more thing that I need to update is the share count. So give me a second here. And I don't have the total number of shares there. So let me do it a different way. Yeah, so 70% discount if we use a 9.5 discount rate. Even if you said, well, Africa's a little risky, you're looking at a stock that's driving a lot of value. So the market's appetite to buy this stock is rational. If you start growing your financials and you start growing them at this rate, and you're profitable and you generate free cash flow, you deserve this stock appreciation. This is very rational. It looks like they announced on the 28th, the market liked what they saw and the stock went higher. So congratulations to Airtel Africa. You've been operating a very good business. Congratulations to Airtel Africa stockholders. You found a very good stock to invest in. So that is my analysis on Airtel Africa. Looks good. Good one. There's a lot of small caps out there that have good valuations. And the one thing about small caps, it's a bit unfair, but sometimes they just get sold off and there's no logical reason. But that's what happens with small caps. They just don't hold their value as well as big caps. Big caps tend to be stocks that everybody's familiar with and they get held by portfolios. And small caps tend to be more volatile and sell off a lot faster. So just be aware of that sometimes you may be sitting on a small cap that looks terrific, but it just doesn't move. That's not the case for Airtel Africa. They have been on the move. Investors have noticed that this is a good investment and they've bought in. So it's not a stock that's, not catching the right attention. It actually went up 2.8% today on a day when the market was fairly crummy. So Airtel Africa looking good. Thank you, sir, for the sponsorship of the super chat, and good luck to you. Thank you so much for joining this stream. All right. So let me catch up on comments to say hello to everybody. And hello from New York City, Jay Zeb. Good to see you, Jamie. I'll take a look at Iran if you sponsor a super chat. Be glad to talk about that data center company. Have I ever seen anything as expensive as Big House? Big House Juice asked, have I seen anything as expensive as Palantir? Yeah, once or twice. It is expensive, but again, when you look at the fundamentals, you see why people like the stock. It's like it's got really good metrics to it. Just the stock price is too high. So it's kind of a an awkward situation. Or I don't know about awkward being the right word. It's just interesting that the stock price has gotten where it's gotten, and maybe it doesn't go much higher because, investors have to at some point be realistic. The company is going to grow to where it's at. We know what it's doing, and still the stock doesn't rise. So maybe that's the sign that it's hit a limit and it's going to stay there for a while. Blocks for fun. Good to see you. Thanks for joining tonight. I hope you are doing well. So today's been a day where, if you didn't lose too much, you're a winner. Because some stocks are just torched. They went down hard. And, it's a day when, excuse me for a second. All right. And it's a day when, some stocks really got taken down. And in the case of like Palantir and Uber, we're going to cover Uber in a little bit. It just didn't make sense. Uber had really good earnings. So did Palantir. All right. Let's take a look at Sezzle. Somebody asked for us to look at Sezzle. Sezzle operates as a technology-enabled payments company primarily in the United States and Canada. The company offers payment solution in-store and at online retail stores through proprietary payment solution that connects consumers with merchants for instantly extends credit at point of sale. Okay. So they're using technology to extend credit. Let's take a look at their website just to get re-familiar with these guys. So Sezzle. Buy now, pay later. It's an interesting model. How they make money is they're basically charging the retailer. Let's just pretend that I'm buying this phone. It's $1,000 phone. And they say, hey, retailer, if you want to use Sezzle, somebody can buy now and pay later, and we'll take over the risk. We'll give you the money for the phone minus our fee. And their fee is like 3%, 5%. So right off the bat, they pay the retailer out of $1,000 phone, they pay them $950. And then they have the consumer pay them, and they'll have 4 easy installments over 6 weeks. So they're carrying, in essence, that small loan for 6 weeks and earning 3 to 5%. Well, if you annualize that number, you're doing 30 to 40% rate of return on that capital you're putting into the process. It's a very good margin. It's very lucrative if they can make it work. The other piece to it that's really important is they can't have too many write-offs. You can't have a bunch of loans going to people that don't pay you, because there goes all your profit, because you're basically covering for a lot of bad loans. This is not a unique model. This is a model that's being provided by companies like PayPal and other companies. So we know what they do. What's this stock been doing? It's been a little while since I visited with Sezzle, but it looks like the stock really took off. Coming out of April, it just shot up. Now with low interest rates, that's going to help Sezzle. Low interest rates, that means financial services companies are going to be pressed to try to go find where they can earn a very good net interest margin or yield. Where these guys have a model where they kind of have a unique model that provides a very good rate of return. Nonetheless, over the last 4 months, the stock's really crashed from 182 down to 61. Over the 1 month, the pain continues. They're going to announce tomorrow. Very timely for you to ask about Sezzle. Taking a look at a preview of a stock that's going to announce. They're a small cap, $2 billion. Again, these small caps, they could really torture an investor. Over the last month, I'm sure this has been kind of like hot water to many investors. And hopefully you're one of the investors that bought here and you're still sitting on a nice gain. And hopefully you didn't buy up here and are sitting on a big loss. This company has a PE ratio that's quite decent, 20.95, 16.94 for 2026. Analysts think it's highly discounted. Looking at the growth, this is a small company, but it's growing really fast. Impressive. In 2024, they grew by that rate. Looking at the trailing 4 quarters, very good growth. This is why the stock was shooting up like it did with the high being achieved back in July. Is they were growing at 100%, 123%. Those are fantastic growth rates. These are awesome growth rates. Okay. You find a business like this. To me, this communicates retailers are using the Sezzle program to sell product. They like the terms that Sezzle has. Consumers are comfortable buying using Sezzle. Those things are good things. They're building a brand. They're growing really fast. Their margin is good. See their gross profit. Back to what I described as how they make money. It's a very good way of making money. Gross margins of 73%, terrific. Profit margins are good. Now, they deployed some capital in the last quarter. So that's drove down their free cash flow for the quarter. Now, they're a young business. So with these young businesses, it's okay that they don't have free cash flow. There's some fundamentals that they need more time to establish their businesses, to establish scale, get their operations well set up. So if they have terrific growth, which they do, they have good gross margins, which they do, I could work with that, because then I could just expect that over time, when they get bigger, more mature, they're going to become more valuable. So this one here so far, I want to leave it on the table and continue to look at it, because I think we're looking at potentially a good business for the future. All right, so we have good gross margins. The cash flow on the trailing 12 months is not setting any records because, again, they're a young business. So we're going to leave that alone for a little bit. Forecast. Only 4 analysts cover it. One analyst think this is a $200 stock. Worst case scenario analyst, $60 stock. Now, their growth has been incredible, and it's going to go down to just very good. If they grow by 27% in 2026, that's going to be a good year. They're not that big, so I'm not going to say it's a great growth rate. 572 million is a pretty good number for a revenue line. Growing at 27% looks good. Their profits are expanding nicely, and their PE ratio is going to come down to 14. This looks like a good stock. If we look at how the stock's been trading lower, it's setting up to have an earnings call. We're in a pretty good sell-off, just judging from today. We can see this stock sell off with the rest of the market unjustly, and this be a nice little opportunity. It's been selling off recently. So when will it start to rally is the important question. And on a stock like this, I think I might have a valuation. Let's take a look. So looking at their valuation, if we go earnings per share, it's discounted. Their free cash flow isn't very good, so they're kind of growing into that number. This is a very good watch stock. I'll be watching it tomorrow. And if it starts to rally, it might be an interesting stock to consider. I think if you just value the company on earnings per share, it has a good value. The other pieces that I would bring to the table on Sezzle is I think they have a good business. They're growing really fast, which is good. If they can continue to grow faster than 27%, the stock's going to be fine. It's going to flourish. They got to keep getting critical mass, because at some point, one of the, buy now, pay later platforms is going to be the dominant brand, right? One brand is going to be it. And whoever establishes that, for example, Uber in ride hailing, that's the number one brand. So most people, they have Uber installed on their phones, and when they need a ride, they call an Uber. Good to go. Well, that brand has a lot of power, a lot of value. So Sezzle's got to keep growing before somebody else becomes a dominant brand. And they are not the dominant brand right now. There's other companies, I think Upstart, PayPal. There's a couple of others that are bigger than Sezzle. So that'll be one of the things that you'd have to track if you wanted to be a Sezzle investor or considered investing in Sezzle. I would encourage you to compare them against their peers, which are these other buy now, pay later options, and then go with the option that gives you the best risk to reward, which may not be the most discounted stock. It may be a company that you believe in more. You have greater conviction on that company, and it provides a very good rate of return. So that is Sezzle. Thank you for asking. Looks like Dwayne is in. You want to go over Meta? Glad to do it, sir. But I could tell you the story is not going to be pretty. It's going to be a little ugly. I'm a huge Meta stockholder, and we'll go over that. AMKR. I'm not familiar with that one. We'll take a look. Just be a little patient. You got like 3-4 stocks ahead of Meta, so we'll get there. Paul, good to see you. Is Gib in the same boat of CRM and Adobe? Let me answer that for you. I'm going to get to it in a little bit. Let me see if I could take a quick peek at it, and I could tell you if they're in the same industry. And maybe that's the response you're looking for. So Gib, GIB, so CGI. So I'll have to look at this. Let me put it on the list, because they may be services and they may be very different than Salesforce or Adobe. But if they're professional services, they're not as valuable as Salesforce or Adobe. So let me kind of put that on the list. We'll come back to it. All right, let me jump over to Uber. And thanks for the positive chat, everybody. Thank you so much. And we're going to jump into Uber. Uber, I went over the earnings. I read the earnings report, went over their PowerPoint slide. I listened to the earnings call. And the market I think the market woke up in a selling mood. We're going to sell Palantir. We're going to sell Uber. We're going to sell. And it sold Uber for sure. The only thing I could say is Uber was way down, and it did recover some of its price. I bought shares down here, so I may have a future in day trading, but I won't be a day trader because I love long-term investing. I like expanding my wealth. But I did buy some shares at the low point after I got done examining the company and establishing that, man, I don't know what the market's expecting from this company, but let's take a look. $197 billion market cap. I believe this could be a $1 trillion market cap company at some point. The 1 year looks decent. 5 year looks good. Year to date looks real good. 56.9% rate of appreciation. The revenue, 49.6. So they're getting pretty big. That's a pretty big company. P ratio is really low this year. It's going to go up next year. Uber is growing, and they explained that on their earnings call. I think some of their costs are a little bit higher, and the analysts didn't like that, or investors didn't like that their profitability was not as good as they would have liked. But Uber explained that they're going into some new businesses, one of them being robotaxi, the other one being that they want to start delivering a lot more groceries and retail product. So if you think about, hey, you're maybe at home and let's say you're a parent, and I could tell you firsthand, when we had little kids, let's say I needed a box of diapers. Boy, it would have been nice to have Uber. Just fetch that, bring it to my house, because having little kids, it's a 24/7 operation. You can barely spare 5 minutes. So that would have been really convenient. And Uber's trying to do more of that. Well, as they establish those businesses, you incur some setup costs. You're not as efficient the first go around. But once you start getting your scale and you get your economies of scale and your maturity, then you become more profitable. So they explained that. And I guess the market was just in the mood to sell off. Looking at the quarters, they grew by 20% in the quarter. That was terrific. They've been growing really nicely. I like to see the acceleration in growth in the last quarter that they had. And they had decent profit. Now, this is Uber. They have to share the money with the drivers. So it's not going to be a 90% gross margin company. It's going to be 34% because they are sharing it with the driver. But the good news is they don't have to put a ton of capital into their business because the drivers buy their own cars. The delivery people buy their own equipment. So that's a good thing. They could scale up and grow quite fast, which is how they have good margins and a very good free cash flow rate. So the cash flow, the profit looked okay to me. 31 analysts cover the stock, and they do believe there's a discount available on Uber at 13.36%. The low price target $78, high being $150. I'm probably with the group that's closer to $150. They're going to keep growing. Look at this growth. Very good growth. Next year, 15%. They're going to be $76 billion in revenue in 2028. Looks great. And their profits are going to really expand next year and expand the year after. Their profits are going to double over the next couple of years. And their PE ratio is going to drop unless the stock price goes up, which I think the stock price is going to go much higher. So Uber, I think, is setting up to have a very nice long-term appreciation run, and I want to be a part of it. When I value Uber, I have a nice discount calculated of 57%. And I just did it this morning. It looks good. I bought shares, and I'm good with Uber. And it's a solid business. They have a strong grasp on this market. They have market share lead in the market. And I think the stock is worth a lot more than its current price. So I'll continue to buy into Uber. So I know somebody asked about Uber, and there you go. Let's keep rolling. We're going to look at AXON. AXON. Axon Enterprise. I think Carlos asked about this. Axon Enterprise develops, manufactures, and sells conducted energy devices, CEDs, under the Taser brand in the U.S. and internationally. It operates through two segments, software and sensors. And then Taser. The company offers hardware and cloud-based software solutions that enable law enforcement to capture, securely store, manage, share, and analyze video and other digital evidence. So I know law enforcement's putting a lot more body cameras on officers, and I know that's an area of interest for the public and probably law enforcement. Okay. So these guys, I think, have a product that is a Taser product. Look at that. They have VR headsets, probably for training. So all kinds of equipment for law enforcement. They're doing drones. Protect your airspace from unauthorized drones. Okay. Yeah, that is important. That's one of the things I worry about. So many drones are out there. They do training. So you got some AR goggles. You got training for law enforcement. Okay. All right. So these guys are doing technology within law enforcement and to some extent aerospace and defense. Or I guess I should probably say more on the defense side. The stock was down today, but a lot of stocks were down. After hours, whew, just going on a slide here, down 20%. 1 year, this is before the big drop. It's up 65%. Once we're done dropping, we're going to be down here. Investors will still be in the positive, but this stock has really been under pressure for 3, 4, 5 months. This is a $55 billion market cap company with revenues of $2.5 billion. That is an expensive ratio. You're paying over 20 times revenue, which is expensive. If they're growing really fast, you can justify it. But if they're not growing really fast, it's an expensive ratio. PE ratio 225 is very expensive. Forward P of 98.9, very expensive. Discounted by 16%. Interesting. Let's see what kind of growth we're dealing with. So last year they grew by 33.4%. That is very decent growth on a $2 billion number. More recently, this is taking into account what they just closed. When did they announce their earnings? They announced them today. So when we go and we look at their growth looks pretty decent. Maybe they guided lower. They were like, hey, we had a decent quarter, but we just want to tell you investors that we are not completely confident that we're going to have this type of growth in the future. If that's the case, that's why the market is selling off the stock. They don't want to be hanging on to the stock if they're going to stop growing. This is a company experiencing growth, very good growth. This means customers like the product. They're seeing value in the product. They're buying more product. That is a very good sign. Gross profit's decent. Looks like it's going to be about 60% gross profit margins. Looking at the free cash flow for the trailing 12 months, 145 million. And it's not showing the upward growth in free cash flow that I like to see. It actually was doing that, but then it stopped. You see that now they're putting more capital into the business, or for some reason, cash is kind of being hard to come by. So that's going to lessen the value of the stock. So gross margins are good. All right. And I'm curious to see in the quarterly, what happened to cash? Why is the cash not as good as... So they had a bad quarter in the June quarter. They consumed a lot of cash there. And now the quarter they just reported, not a lot of cash produced. So the last 3 quarters of cash have been terrible. So the stock has been under pressure. I think the fundamentals are disappointing investors. So that's what's going on here. Overall, I mean, the 5-year, if you bought this stock a while back, you're doing just fine. But looking at this year, this stock's under pressure. A lot of pressure tonight. So analysts, 15 of them cover this stock. There are some analysts that think it could go to 1,000. Some analysts believe it's worth 700. So on average, there's a 16% discount. They're expected to continue to grow. That looks good. and profits are expected to expand. That looks good, but the forward P is just really high. Huh. And see, their profitability next year is going to grow by 17%, while the actual revenue is grown by 24%. And that might be part of the pressure to sell off the stock, is their fundamentals are actually looking worse, not better. And they're not expanding their profit as well as they've been expanding their revenue. So this number is what's turning me off. That's a pretty high earnings per share number. Their free cash flow is low. Earnings per share is high. Let me take a peek at their balance sheet. Balance sheet's fine. They have more cash than debt. So this one here is a pass for me. I think the best days are behind this stock. Most definitely this stock really worked, but we're looking at a stock that really hasn't done anything since May, while the rest of the market's been just driving higher. And their fundamentals, although they're good, the price of the stock just got too high. That's why the PE ratio is so darn high, and it's staying so darn high. Well, no thanks. Their margins are okay, but they're not great. Their free cash flow is bad for the last 3 quarters. So there's just too much there that's not going right in order for me to pay for a stock that's appreciated close to 600% over the last 5 years. So this one would be a pass for me. So thanks for asking about that one, Carlos. Looks like Zeta announced up 9.28%. Boy, Zeta needed that, because the stock has not been going higher. It's been going lower. I own a small position in Zeta. They have terrific financials. I'll show that to you in a little bit. I haven't looked at their earnings, but I'm just judging from what I've seen in the past. This company's had terrific fundamentals. Let's take a look. So year to date, this is down 7%, down 40% for the 1 year. And it's been kind of a wild ride for the 5 year. Now, this is a $4 billion market cap company. Zeta is an ad tech company similar to AppLovin and also the Trade Desk, if you're familiar with that stock. They have $1.22 billion of revenue, so you're paying less than 4 times revenue for the company. Forward P is 22.3. Doesn't look too bad, discounted by 67%. This company grew last year by 38%. Let's take a look at the quarterly growth in the last quarter. Just announced 25.67. And you see a lot of green on the screen, just growth. And this just shows me that customers like their solution. They're using it for their ad tech needs. That looks good. And it looks like Juvie 1503. The Q3 presentation is really insightful. Very good. So what I like about these software plays, right, is their margins. And this one has good margins. I think close to high 60s. No, 60%, excuse me. 60% gross margins. As they get bigger, it's going to probably get closer to what AppLovin has, which is close to 80%, which would be terrific. Free cash flow, this company is raising or increasing their free cash flow yield. Very good. With maturity and scale, they get more cash out of the business. So that looks really good. 52 million. So that's a very good number. Maybe that's why the stock's really going up higher. Trailing 12 months number on the free cash flow is $159.6 million. Very good. So I'm going to note that because I'm going to need that in a little bit. Looking at what analysts think about Zeta, 13 of them cover it, and some think it could go up to $45 a share. I like the sound of that. I could go for tripling my money. And the worst case scenario is 18. So it's actually the worst price target is above its current stock price. It's expected they're going to keep growing at a very good clip and become a $2 billion revenue company. Be nice to see them accelerate that, kind of innovate, maybe acquire another business and just get bigger because it's important. AppLovin is killing it. I own AppLovin as well. I own a lot more AppLovin than I do Zeta. But Zeta's numbers look so darn good, I couldn't resist. I bought some shares. And you see that their forward P is really coming down, but I think the stock price is going to go up. In fact, they become an acquisition target for like an AppLovin or somebody that wants to acquire Zeta and take over this really profitable business. So up 9.28%. Glad to see that because one of my other stocks, Pinterest, is a sick puppy tonight. It's not doing well. But let's take a look at Zeta. Let's keep the positive momentum going with Zeta. We'll look at Pinterest. So these guys, I updated them in August. The free cash flow that I was using wasn't quite as good. I'm just going to leave this steady for now, but it's a nice discounted stock. I like what they're doing. I like their industry. Now it's a small cap, so I didn't, dive, head first in investing in Zeta. I had a measured first position. It looks like their earnings really met what the street wanted to see. Maybe I'll increase my investment in Zeta. So Zeta's looking good. I'm glad they had a good night with earnings. And I'm going to do some homework on them and probably start buying some more shares. Go from a really small position to a little bit bigger of a position. I still wouldn't put too much money into this small cap. I have more money in AppLovin. But Zeta's having a good night. Thanks for asking about Zeta. So Benton, yeah, the market was a little tough today. And we could stay there, by the way. I wouldn't be totally surprised if tomorrow we wake up and we're at it again. We got a lot of stocks selling off. Speaking of stocks selling off, look at Meta. This thing's had a bad 5 days, huh? 16.5% from a big, massive cap, right? They were like 1.7, 1.8 trillion when this whole little sell-off started. And they really brought it on themselves. They spent a lot of money in the data center, and they don't have anything to show for it. So they didn't have great explanations, by the way, on their earnings call. I did listen to them, and they tried to get away with, hey, we're going to invest. We're going to try to be ahead of the curve. And if we don't need it for AI, we'll use it for our core business. Well, I didn't like that response at all. I think you should have a good sense of what you need to invest in the business that's really going to have a short-term, positive return on capital. If not, don't deploy the capital. Do your homework. Make sure that you're investing the capital of the business in a very intelligent way that is going to drive return on investment. So they got, disciplined by the market that, hey, you want to keep spending capital like that, we will sell off your stock. And I own a lot of Meta, so I felt the pain. I felt the pain of this stock going down as much as it has. It continues to go down. So I think the leadership over at Meta got the message. Rein in your CapEx. It still has good fundamentals. It's a very good business. Let's not throw away the baby with the bathwater on this one. P ratio 27.7, forward P of 21. Strong buy with a 31% discount. I agree with that discount. I'm around that discount level. And they continue to grow a massive business. Look at these growth numbers. This is just for the quarter, 51.2 billion, and they grew by 26. So what's lost in that kind of negative perception around the stock is they did grow their top line revenue fantastically. And they have awesome margins. Look at these margins. They have 81.68% margins. Awesome. Great job. Awesome margins, great growth. Free profitability's there, free cash flow margins are there. They just got to stop, spending money in the data center like they're just, the coolest company on Wall Street. Analysts are, putting price targets out there that say the stock could go up 31%. I agree with those price predictions or targets. I think the stock right now is under pressure and an opportunity. If I didn't own so much Meta, I'd be buying it. The growth of the company is going to continue. These are big numbers. They're going to be a $300 billion revenue company growing at 9% in 2028. The P ratio is dropping, and it's not going to drop that low. The stock price is going to go up. The stock price is going to go up to $1,000 a share. That's my expectation. And I'm keeping my shares. If I didn't own as much Meta, I'd be buying it left and right. So Meta, under pressure. I guess the management team got the message from the owners, which are the stockholders. Do not overspend on that data center. AI is an interesting idea, but it's an idea. We don't have any revenues yet. So don't overspend. Let's look at AMKR. Amkor Technology. Amkor Technology provides outsourced semiconductor packaging and test services in the US, Japan, Europe, and the Asia Pacific. Okay. So they're in the semiconductor space doing packaging, testing services. Okay. And they announced their earnings. Okay. So they have a lot of locations in Asia, and they have a location here in San Diego, Tempe, Arizona. And I know that TSM is opening their big foundry in this area as well. They have a location in Austin and then in San Jose. All right, so let's take a look. So they announced on October 27th. The stock's doing well, up 37%. The market did like what they announced. The stock sold off. A lot of semiconductor companies sold off. The 1 year up 35%. 5 year looks really good. And look at this sell-off from July 8th, 2028 to August. This stock was really under pressure, and it's really recovered nicely. Okay. So this is interesting. It's a small cap, 8.7 billion with revenues of 6.45 billion. P ratio 28.4. Analysts think it's fairly priced. Now, interesting that last year they didn't have growth, and the year before that, 2023, while the industry was just flourishing. And revenue this year, if we look at the quarterly, has been growing, but they're not setting any records. These are like slow growth numbers. So I could show you semiconductor companies that are growing far better than this. And this is not impressive to me. It's kind of barely growing after having some negative quarters. So I'm not sure what the story is on this stock, if it's going to flourish going forward or not. But this one here just doesn't have enough value for me to really get excited. Let's take a look at the trailing 12 months cash flow. And it hasn't been growing. This is trailing 12 months. You see that it's actually been contracting. So that's a bad sign. So very little growth. Gross margins are very low. They're just doing a service. So this is not like NVIDIA that has 85% margins and stuff like that. Very low margins. So this is a pass for me. Low margins, growth hasn't been proven. Cash flow has been declining. I don't need a stock like that in my portfolio. I need one that is going to be the next NVIDIA. All right, let me handle a quick question. And as Valderod, the answer is yes. I share the DCF analysis sheet with advanced members or higher. I think that's what you are. And if you could please email me, and I'm putting my email address in the chat, I will get you set up with access to the shared folder. It has the model that you just saw, as well as I put a record of my valuations and research. I update it about once a month, and you can also take a look at what I have as a valuation for stocks 24/7, because you'll have access to the shared directory. I'm also going to invite you to member calls, invite you to the Discord, and just give you all the perks. So please email me. I'll get you set up. And thanks for asking about that. Thanks for becoming a member. All right. So I'm going to handle GIB. I think there was a question there. Is this the one that was GIB? It's GIB. And what was the question? Are they similar to Salesforce and Adobe? So let's kind of start from the beginning and get familiar with this business. What I wanted to determine is, do they provide professional services, or are they in fact a software company? Very important to know that. Software companies are worth a lot more. Professional services companies, not so much. So let's take a look. So they provide, all right, so they do services, they do business consulting, systems integration. Okay, this is low margin and not good. So industries, insights. Now let's take a look at their financials, and then I'll be able to tell you if this is a software company or not. So gross margin, they're a services company. So if we look at Salesforce or Adobe, right? Take a look at Adobe. A software company is going to have much better margins. It's just more valuable. 89.03%, profit margin 25. These guys, their gross margins 20.49, their profit margins 50. So they just drive less value. And their free cash flow is pretty darn decent, but hasn't been growing a ton. Where you look at Adobe, their free cash flow is much higher, and it's been growing over time from 2.7 all the way to 7.8. So this company is not like Salesforce, and it's not like Adobe. It's not a software company. It's a professional services company in the same ecosystem, but not the same type of business. And these guys, market cap 19.11 billion, revenue 11.41. P ratio of 15.4, forward P of 13.5. Those are decent numbers. Analysts think it's really discounted. Year to date, down. Now, why is this potentially down? There's a threat. AI could lower the demand for professional services for this industry, because with AI, if you're making it easier for companies to develop their own software, implement their own software, individuals to create their own software, they're not going to need systems integrators or professional services companies as much in the future. So this one here is not as valuable as Salesforce. They've been selling off. I think the story is kind of a threatening one to them, because AI could lessen demand for professional services. This one here, if we look at, they're going to close their fiscal year in September 30th. So when they announce their earnings tomorrow, it's going to be for the full year. Now, I would say that they have been growing really well. That looks good. I just don't own any professional services because I don't like these margins. I just don't like the margins. I'd rather buy high margin businesses, high cash flow businesses that are discounted. This one doesn't qualify. This one's low margins. They're always going to be low margins. And the reason they're low margins is these guys are professional services. So when they get a new contract that they're going to go deliver some services, they have to hire all these qualified people that they have to pay a very good rate for. and that costs money. So then they go deliver the project, and voila, a lot of the cost is in the employee salary. Nothing against that. It's just not a very valuable business to be in. You want to be in a business where they have very good barriers of entry, very high margins. They have something that's very unique and special, like a Meta, like a Google Alphabet with Google Search or YouTube. And those businesses are very valuable because they have a lot of profit, a lot of cash flow. They keep growing. They're part of the future and all that good stuff. And this one is not. This one is not that type of business. So it is a solid pass for me. All right. So I'm going to get to a stock that I needed to take a look at. It's for a member that got me this request. Now, it's been great to have you guys, man. You guys have been on it tonight. Thanks, everybody, for all the comments. And FYI, I'm a one-man operation, as you probably noticed. There are so many comments coming in. If I missed your comment, I apologize in advance. I don't think I've missed any comments. If you're a member, I'm reading your comment. I'm taking your request. If you put a super chat, most definitely I take your request. But keep in mind, one person operation, I make errors from time to time. Oh, look at that. Entering in the wrong system. We're going to go to waste management. Waste management. And look at that. Not all stocks went down. Today, waste management went up. And it's going up in after hours year to date. This stock is not even breaking even. 1 year, not breaking even. What's going on? Why is waste management selling off? 5 year, it's a pretty decent return. When you add that dividend, you're up there around 80%, rate of appreciation and return, overall return, I should say. That's decent. That's decent from a company that is a necessity. We're not going to get away without waste management. They take out the garbage from neighborhoods. We take out our trash cans to the street, and these hardworking people pick that stuff up. They take it to a landfill, process it, and keep our neighborhoods nice and clean, keep our cities nice and clean. They partner with businesses so they can get rid of their waste. So a necessity company with $80 billion in market cap, revenues of $25 billion. P ratio seems a little high, 31.6. Forward P 25 looks a little better. Analysts think it's discounted. Now this year I showed it's not performing great. So what's the story? Last year they grew pretty decently. All right. And looking at the quarterly, and when did they announce? 27th. So the numbers are quite fresh. All right. So they grew quite well. 14.87, 19% the previous quarter. Look at these growth numbers. That looks good. Why is the market selling this thing off? That's interesting. All right. So their margins are going to be 45% or so. So let's see here. Gross margins 40.5. 1 second, everybody. My wife just showed me one of my favorite foods that she bought me while she was in Los Angeles. So that is cause for celebration. I will be eating well tonight, everybody. All right. So gross margins, 40%. This is a business that's a necessity. It's a stable business. And it is profitable. Profits have been declining a little bit. But man, I just don't understand the big sell-off. This is not a bad business to buy nowadays because the AI story is really taking on so much capital and the prices are so high. When that bubble either lets out some air or pops, waste management's going to look like a beautiful stock because its revenues are very solid. They're not going to go down. They're going to keep going up because we continue to use their services. The way we live isn't going to change overnight. In fact, it's probably, we're going to drive more trash because we keep buying stuff from Amazon. And I can tell you personally, one of the areas that I feel a little bad about is we order a lot of stuff from Amazon. So I'm over cutting boxes next to our recycling bin thinking, man, there's a lot of cardboard. I kind of wish we didn't use as much cardboard at our household, but we keep ordering on Amazon because it's so convenient. Well, that's the world nowadays. Is, man, it's such a great service that we consume a lot now. 18 analysts cover the stock. They are high on the stock, 23% discount. So I'm liking what I'm seeing with Waste Management. I'm liking that the stock's really sold off. It's been growing. It's going to continue to grow. And the earnings per share is going to expand nicely. The P ratio is going to come down. I think the stock's going to go up. I think Waste Management's looking like a good stock. Let's jump into a valuation on this one because I like buying. So I'm 57, right? If I was 27, I'd be swinging for the fences. I'd be trying to hit home runs often. At 57, I do hit home runs, but I try to make them be smart moves. I like stocks that double in value every 5 years. And once in a while, I grab a really good one like Astera Labs or Robinhood. I've got a couple that have just been phenomenal over the last couple of years. And I bought TSM and tripled my money a couple of years back. I've had some really good winners. But Waste Management, I have a lot of conviction around because the stability of their business, like the strength and how solid their business is, that's an attraction to me. That's something that I can hang my hat on. So let's take a look at evaluation, and we're going to build this one together here. So we're going to go step by step. If you wanted to do valuations using free cash flows, you're in luck. That is what we're going to do. And it looks like the new member that just joined and asked me about the DCF sheet. We're going to do that here step by step. There's also videos on the channel for members. You have to be a member, which you are. And you can see my step-by-step instruction on how to use the model. All right, so let's get into it. So Waste Management, what are they like? What are like a business? They're not like AppLovin, but I'm going to put them next to Kroger. Kroger is a stable business, nice and steady. Yeah, that's a good one. So let's put it up here. So what I'm going to do is I'm going to copy the valuation for Kroger, which is basically the model I created. This model follows basically the calculations that I was taught when I was doing my undergraduate in accounting and finance, and then I got an MBA. But then I returned to it when I became a very big stock investor, and I created my own model because I really wanted to know what intrinsic value for a stock was based on cash flows. And there wasn't any really good tools out there. So I created my own. And I would thank other YouTubers who show their tools. So it gave me a sense of, how I could build mine. But then I created it originally on an Excel spreadsheet, and now it's in a Google Sheet. And that is what we're doing here, Waste Management. This is a low-risk business. It's not going away. It is going to be around for a long time. And let's take a look at what kind of free cash flow are we dealing with. For the trailing 12 months, Waste Management produced $2.4 billion in free cash flow. And they're growing at a good clip. So let me get that number in there first. They were growing at, trailing 12 months, they're growing at 15.88%. Man, that's really good growth. I'm going to grow the initial cash flow by 10% because we're always looking forward. I put in the trailing 12 months, but I'm thinking what's going to be the cash flow if I look 12 months forward. So I'm going to grow it by 10%. And then the sustaining growth rate, I'm going to put it 7% there. So we have intrinsic value of 76.8. Let's add cash and take away debt. And I do that because sometimes you have these companies that drive a lot of cash, but they have a lot of debt. Well, that's not good. Got to decrement the debt. And these guys have $23,360,000,000. So that see how that decrements, reduces the equity value. I got to update my share count so we can get the market cap correct. These guys have 402 million shares outstanding. Man, this is a good looking stock. So market cap 80. Why is this showing 50%? Oh, okay. I made an error here. So I think I typed over a formula. So looking at cash flow, this debt is what's taken away a lot of value. And on free cash flow, this company is priced 34% too high. So that's why I take away debt, because debt really is a decrement to overall value. We're owners in the business. And if we wanted to own the business outright, we'd have to buy all the shares and pay off all the debt, because the debt holders have basically a lien on the business. If we have to pay them the cash, or they'll claw it out through courts, right? So that is a stock that looks interesting, but man, it's just it's a little too expensive. Maybe the market was showing us that, hey, the stock is just too expensive. Investors like the company because they understand it, but it's just a little too expensive. Next year, these guys are going to have an $8.59 per share. I'm going to give them a 24 PE. They're growing that number nicely, so I'm going to go with 8% growth rate. So this is a stock that is not too expensive, but it's not discounted. Man, in a stock like this, it's really important how you buy a stock. You got to buy at the right times. If you buy at the right times, man, the ride is wonderful. I've doubled my money on Kroger as an example, because I bought at the right times when it's really discounted. The market doesn't like it, sells it off. I think the market's not correct. I buy Kroger. And I'm not seeing that with waste management. Maybe if it sells off a little bit more and brings it down to a share price, maybe of $100 a share, man, I would pick up some shares with both hands. I'd be buying waste management and putting that on my portfolio because I like the business, but I'm not going to overpay for a stock, because it's really important how we buy stocks. That way we can stand to really make a good gain, and we don't sit on a stock that's just going to be having our capital be idle, or worse, you buy a stock and it goes down in price, and then you have a big loss on your hands. Man, that is frustrating, distracting, just not a good thing. So buying a stock under the right conditions, which includes a very good discount once we buy into the business, is really important. So I think I did something wrong there. Let's take a look. Maybe I went after the wrong. Yeah, I did. There we go. That's a little better. All right. So we went over waste management. We just did a full valuation. Now, the result was not a buy result. It's a result that is, hey, the numbers are telling me do not buy waste management. It's too expensive. Wait until it gets sold off some more, because investors look at free cash flow and a forecast of free cash flow. Long-term investors, that's what they depend on, especially a company like Waste Management that is a staple stock. These guys are not going to double in revenue in the next 5 years. They're going to grow gradually as the needs of the public increase. And so this one here is going to be a good watch stock for me, but it's not going to be a good buy at this time. So that was Waste Management. And I'm glad we covered that one, because waste management is one of the important businesses out there that I like to look at. All right. So, Benton, you own CDLR. I looked at CDLR a while back. What's going on with CDLR? So they announced on the 25th. So they went down a little bit. Wow, look at this. Just up and down. So CDLR, together with its subs, engages in offshore wind farm installation operations, maintenance services in Denmark. The company engages in the transportation installation. So they do offshore turbines. Okay. Yep. So this is their equipment. They're installing these. These generate power using the force of the wind. Very good. And they're going to announce in a couple of weeks what's been happening lately. Wow, sell off. This is a small cap, 1.56 billion, revenues of 546. Look at these PEs. Man, super low. And no analysts cover the stock. They grew a lot last year. Looking at the quarterly, man, they just keep, look at these growth numbers. They are installing a lot of this equipment. And I mean, if they are successful in generating power, I know in Europe, the cost of electricity is much higher than what we have here in the US. So if they can build more capacity, I think they're going to have plenty of customers to buy the power. And so these numbers look really, really freaking awesome. And year to date, the stock hasn't had a direction. It had a lot of momentum here. It went up to $28 a share. It's come back down. But man, this is going to be an interesting stock to look at on November 28th, 25th. This is right ahead of Thanksgiving. So this stock will be interesting to look at. The fundamentals look great. The growth looks great. Let's revisit their margins real quick just to see what kind of money they make. So right now they're burning cash. It might be because they're going through a really incredible growth rate. So I forgive them for that. Gross margins of 48.8. That's pretty decent. And profit margins there. Once they either get scale or maybe have bought all the equipment they need and are now just using the equipment to install more of these units, this is going to turn positive. For now, this business is going to be interesting. It's going to be definitely a good watch stock. And as soon as this thing goes up, turns up, and it really shows that, hey, we're going to be a big business growing at this rate. These guys are going to be a force in the future. See if we've got a forecast on them. See, they're going to be $1 billion company in 2026. That's growing fast. Now, how can they sustain that growth? Because this is not what we want. We don't want to grow to be big, or I should say grow to $1 billion and then hit a wall, which is showing here the forecast. There's only a couple of analysts out there. So I would watch this stock and get a good grasp on how are they going to grow in the outer years, 27 and 28. But this could be a multi-bagger because it's so darn small. If these guys are successful, this could turn into a $10 billion market cap company, and you're sitting on an awesome return. So this is a good-looking stock, very good-looking company. That is Cadeler. All right, so that's Cadeler. Let's go over to Pinterest. I see that the comment came in, and Pinterest is down hard. And what's interesting is I looked at their earnings, and the earnings look good. I think their guidance is that they're going to grow 14 to 16%, which isn't all that bad. If you look at their quarterly, they announced, their growth is close to 17% for the quarter, and they're guiding that for fourth quarter, they're going to grow 14 to 16%. That's not bad. They're growing really fast internationally, by the way. I looked at their full report, and I actually like their earnings. They look good. Looking at the growth rate, 16.7. These guys have fantastic free cash flow generation that they've grown. And look at these margins, 79.7. Profit margins are there. They should do more to keep that that profit down to the bottom line, but they are growing, and they're growing internationally, which is exciting because internationally, their growth rate is really high. Makes sense, right? They're a social network predominantly in the US, but they're seeing very high growth in Europe as well as other parts of the world. They have a PE ratio of 11.4, forward P of 16.7. Year to date, this is done okay. Buying at the right times, you'd be sitting on a winner. Over the 1 year, this one's barely staying in the positive, but after tonight, it's not going to be in the positive. It was a darling back in the COVID days or after COVID when everybody was online just because we were socially distanced. But since then, the stock's really settled down. Overall, Pinterest is a discounted stock. I've got a valuation on them, and I think that they're going to be worth a lot more in the future. They're also acquisition target. 27 analysts cover them. They think it's discounted by 31%, and after tonight, they'll be discounted by 50%. And they are, look at this growth, very good growth, 14.9 and then 14.4, 11. They're going to be $6.32 billion in revenue with very good profitability. And this forward P is going to drop, but I think the stock's going to rally at some point. These guys are probably going to be a very good acquisition target. So Pinterest is really discounted, and it looks like it's going to have a pretty big discount tomorrow. I looked at the stock, and I'm probably going to buy some shares tomorrow because I'm looking at their free cash flows. They came in as expected. Growth was a little better than I expected. So overall, I'm seeing a big discount on the stock. So it's one of those stocks I may need to be patient. I have a small position. It's bigger than a small position, but I'm good staying on the stock. I've done so well with Meta. I've done really well with Reddit. And I think Pinterest is the same type of business, really high margins. They have a user community that really likes the experience they have on Pinterest. And I'm good with Pinterest. Good looking stock. It is being sold off and could be a good opportunity for me. So that is Pinterest. So one stock, probably the biggest market cap stock that announced today was Advanced Micro. And let me check the chat really quick before I get into Advanced Micro. Dre, the Generation X. What's up, buddy? Good to see you. What's causing the sell-off? I think stocks were just priced too high. And we're finally seeing that investors just are getting concerned. They're a little bit fearful that, hey, you know what? This could be the beginning of a bigger sell-off. For example, AMD, it's been just killing it, right? It just went up on news that, hey, it did a deal with, I forgot who it did a deal with. Was it OpenAI? That they're going to sell a bunch of chips to them, but they're going to give up 10% of their stock or their market cap to them. And the stocks flourished. But over the last couple of days, the stock, not so much. They announced after the market closed. The market, I guess, didn't see enough to cause it to rally. It's probably feeling like, well, we're really betting on this deal it did with OpenAI. And let's take a look at the rest of the fundamentals. This is a semiconductor stock with $405 billion market cap, revenue at 29.6. And they have a very high PE, 155. Forward P is high as well. Analysts think it's too expensive. The growth for AMD, last year they had 13.6 growth, minus 3.9 the year before. When we look at the quarter grew well, 31.7. Okay, that's very good growth. Now, one thing that AMD's had in the past is they don't generate a lot of cash, which has always been kind of a head scratcher because their peers generate a lot of cash. These guys are $400 billion market cap, and they generate $4 billion, which is 1%. 1% yield on that big market cap. Well, their peers like Broadcom and Nvidia, they generate tens of billions of dollars in free cash flow. These guys have always been a laggard when it came to cash flow, which is interesting. Their gross margins, 50% gross margins, those are decent. They're not great, but they're decent. So their fundamentals have always been decent, but not as great as Intel back in Intel's heyday, and not as good as Nvidia. We have 32 analysts covering them. They think it's a little expensive. Can't argue with that. I think AMD is expensive. See this growth. If they're going to do a big OpenAI deal, they better start seeing growth soon, because they're going to see growth in 26, 27 if everything goes right, and then they're going to hit a wall. And if we get close to this wall with no growth, this stock's going to go down. Their PE is not going to get lower than 26 in the next 4 years. To me, that's just too expensive. Their margins are not as good as their peers. Their free cash flow is nowhere near their peers. And overall, they're not like the dominant player. That's Nvidia in this space. And here's AMD. I think they're priced 13% too high. And I'm agreeing with where the market is at on this stock, or I should say the other analyst. And I'm giving them a very generous free cash flow forecast. I think they could fall short of this forecast, and then the stock price is going to unravel. So AMD under pressure after hours, and it is not a stock that I've liked in the past, and I don't like it tonight either. So we're flying through these stocks. We've covered 13 stocks, covered Pinterest. We're going to do a flyby by a couple more. Arista Networks. What's going on? Oh, man. And Arista Networks has been a stock that I've covered for a couple of years. And at times, I said Arista Networks is too expensive. And some people had a different point of view, which is great. I'm open to feedback. We can have differences in how we look at a stock. Totally cool. But I called it out when these guys were like around here. They sold off really bad. Now they're priced too high again. I'm not against Arista Networks or cyber or networking. I made a lot of money there. But I just think this stock doesn't hold up. PE is really high. Forward PE is too high. Strong buy with just a small discount. But I think they probably announced, and I haven't looked at this announcement, so let's see if we've got the fresh numbers here. We do. So the growth is good, but they're probably guiding that we're not quite sure how we're going to grow over the next quarter or year. And in this case here, the stock is so high, it's priced with such a high PE that you have to meet and exceed the expectations, and you have to keep raising those expectations. If you don't, investors are like, whoa, hey, you're not a magician. Well, we're out. The gross profit on this business, we'll take a look at the margins here. Gross margin is 65%. That's good. It's not quite as good as like a CrowdStrike, Fortinet. Those are better. Zscaler is better on the gross margin line because they do have network equipment in here. They do cyber, but they also do networking equipment. And their free cash flow, this is where the stock kind of falls apart for me. They haven't really grown free cash flow. When I value the stock, it just doesn't measure up based on that free cash flow number. Forecast, 15 analysts cover them, and they are feeling like, hey, this stock is fairly priced. And the market, actual investors are saying, nope, I'm out. I am selling Arista, selling that stock. They're expected to grow at 20%. I wonder what they guided. They're probably guiding toward the lower end without a lot of optimism. And the earnings per share looking good. But the PE is going to just constantly be high. And we're not dealing with a super grower, right? It's just a good growing company. You can find better PEs in Fortinet. Is a good PE ratio. I worked, or I should invested in Zscaler a year and a half ago, and I did really well. I got like a 50% rate of appreciation in roughly a year and a quarter. Mission accomplished. I sold the stock and switched over to Fortinet, which I think is going to do well for me. So this one here, the PE ratio is just too high. I would be paying up too much to buy into Arista Networks, and it's really showing in this sell-off that investors are realizing, man, I bought into a stock that's too expensive. And this does not include the most recent numbers, but I just wanted to do a quick flyby. I think it's priced 33% too high. Just their free cash flow is not good enough. So Arista Networks is priced too high. The market's really pushing the stock lower. And that's a stock that, again, I've covered in the past and kind of gave my analysis and my research. And some people really thought, no, the stock is worth more, which is cool. I like getting that type of feedback that doesn't agree with me. That's good, because sometimes I might have a stock wrong. But on this one here, I did my homework and felt like, this one's just priced too high. So that's what's happening at Arista Networks. Pfizer, they announced slight pickup in their stock, and I think they announced before the market opened. So this one here, not a lot of news. And this is kind of a company that has not been growing. I wonder if they grew in their last quarter. So nope, they contracted a bit, which is the problem with Pfizer. If they can't grow, what do we have? We just have a big giant company that's just going to be idle, which is why I sold my stock. I thought the company was going to do better than it did. And I finally got it off my board, got it off my portfolio, and I'm glad I did so, because this thing is just not, it doesn't have the characteristics I'm looking for. If I'm going to get a slow grower, I want it at a discount. I want it to pick up in share price, pay me that dividend. I'm good to go. But this one here just didn't do it. It didn't perform. It just kept my capital idle, and I moved on. And I'm glad I did so. This earnings kind of confirms I did the right thing by selling Pfizer. Get that off the board. No longer is it a distraction. I'll just look at it in the rear view mirror. Shopify announced before the market opened this morning. Shopify is a cool company. They do e-commerce stuff. And Herdo, thanks so much. I appreciate you attending, and thanks for stopping by. And thanks to everybody for stopping by. Thanks for spending part of your evening with me and taking a look at stocks, seeing what's going on. Why is the market selling so many stocks off? Shopify down 7%. They announced their earnings this morning. Shopify always looks a little expensive to me. $209 billion market cap. This is one of the larger companies that's headquartered up in Canada. Really cool company. They do e-commerce technology, and they actually provide it as a service so businesses could put an e-commerce platform out there. And Shopify has creative ways that businesses can use the platform, and creative ways to pay for it, I should say, which is good. That way they keep growing. This is a $10.7 billion market revenue company. So you're paying close to 20 times revenue for the company, which is a little expensive. 118 PE is rich. So is 95 forward PE. This is a expensive stock. Now the stock has been doing well year to date. 1 year, very well. 5 year, we saw a really big sell-off in 22, but since then it's really done well. So it's been a winner. It's been a really, really good winner. Now this one here is probably priced a little too high according to analysts. Let's take a look at what they announced on their earnings. Their growth looked good, 31.55. Look really good. and they are a $10 billion outfit. So growing by that clip is very good. I am impressed with that growth rate. Now, one thing that these guys don't do is generate a lot of cash. You see, this cash flow is not very good. 1.9 billion. They're more than $200 billion market cap companies. So that's less than 1% of the market cap. That's not high enough. You know, I have businesses that are 200 billion in market cap that are doing 10 billion in free cash flow. Well, I'd rather buy that business that has a way better yield on cash flow. So these guys here, gross margins 48.7, operating margin 15, and then profit margin of 16.65. So overall, I mean, Shopify is a popular stock. A lot of people understand what they do. I root for them because I think it's a good business. A lot of customers are happy with them. 34 analysts cover Shopify, and they think the stock is priced, I think, fairly or a little too high, 9% too high. That's after they sold off today. Now they keep growing, which is very good. They keep growing their profits, very good. But look at this PE; it stays really high, and it's not a fantastic grower, right? Facebook is growing, or Meta is growing faster than this, and Meta is a giant company. And other businesses are growing just as well, and they have much lower PEs with better margins. So I've never really been in Shopify. I've never been a stockholder because these valuations are the valuation of the stock doesn't match the stock price. It always shows as it being a stock price that's priced too high. And where do I have Shopify? So Shopify, it's priced 45% too high. So I'm way off on the valuation. I'll continue to be a fan, but I will not be a shareholder of Shopify. It's under pressure. We'll see what happens. This is a sell-off. It's a sell-off because stock prices were too high. That's what's going on. All right. So Peyton, good to see you. Let's see here. Dwayne, great to see you. Thanks, buddy. All right. So crypto. All right. Thank you, sir. Yeah, we'll see where that goes. Man, you know, the growth is pretty darn amazing. Just keep an eye on that long-term growth. You know, the long-term growth, that they get close to hitting the wall on growth, you gotta be aware of it, because you can buy and maybe the stock flies up. Just be aware of it so that you know your exit strategy. That way, you know, hey, I'm going to own it for a year and then get out with my gain, and then just be aware that it's supposed to stop growing at some point. Or if you see a revelation in the stock where, hey, we're going to keep growing because we're going to build out maybe the region that they're in right now, and then they're going to move maybe to another region where they want their wind powered turbines to be installed. Well, phenomenal. They open up a new market. So those types of things, you know, keep an eye on, because it's a small cap. That thing can become a multi-bagger. I'm going to watch it, and I think it's worth watching. So, all right, everybody. We covered a lot of ground. We covered 16 stocks. That was awesome. And let's see where we go tomorrow. I'm going to stream with Daryl in the morning, and this is our night crew, and we cover things once the market's settled. Tomorrow is the morning crew. It'd be great to have you if you're up for it. And we're going to cover stocks. And you know Daryl, he does the charts. He's awesome at the charts. So I'll do the fundamentals. He'll do the charts. We'll record it if you want to watch it later, or if you want to attend, that'd be awesome. And we'll see where the market goes. Let's see what's happening in the pre-market. Before we conclude, I wanted to talk about a couple of things too. So the futures are down a little bit. We'll see where that goes. That could always change. But crypto, man, Bitcoin's just been under pressure. Bitcoin's down to $100, $100,000 per coin. Not too long ago, it was like $125 per coin. So this thing's been under some pressure, and it kind of shows where we're at with the fear on the street, right? We have Bitcoin's been going up and now coming down. Now that's not overly fun for me. I own, Bitcoin, but it's just reality. We've got some fear in the market, and the market is playing it safe. We'll see where we end up tomorrow. If we're on an extended sell-off, remember that sometimes opportunity is disguised in these bad news events or these sell-offs. Let's keep our eye on the prize, finding awesome businesses that are discounted. The market doesn't quite understand or appreciate enough. We buy them at the right time, then we make a lot of money. That's potentially, this is day one, right? Let's say we sold off like we did in the March, April timeframe when the S&P went down upwards of 18, 19%. That was a great opportunity. We took advantage of it. That's what we want to do this time around if we have that type of an event. So keep your eye on the prize. Keep researching your companies. I like some of the companies we went over, like Cadeler, really interesting little business. We went over Uber that's been selling off. I think it's terrific valuation. Zeta, good to see Zeta have a good earnings. So we covered a lot of good small caps. Just the one thing that small caps, they get kind of mistreated. Sometimes they get sold off unfairly, and it's a little bit frustrating to watch, but it's just reality. Investors can kind of have a lot more confidence in these big caps like the Microsofts, the Berkshire Hathaways, and these small caps they kind of throw away at first sign of fear. Man, get rid of my small caps. And that's why those small caps have such volatility. But if you buy the right small caps, boy, they could really take you for a positive ride and really reward you with great appreciation. So just be aware that temporarily we may see small caps get hammered, but it doesn't mean there isn't good opportunities there. So we'll keep analyzing and trying to find some good diamonds in the pile of these stocks. All right, everybody, that is it for tonight. I had a great time. I hope you found the stream interesting. I really appreciate everybody tuning in. It was awesome. Thank you so much. Thanks for the support, the new member, the super chat. And you guys have a good night. Let's see where we go tomorrow. Let's keep track of this market, see if we can take advantage of a sell-off that is going to give us great prices on stocks. Have a good night, everyone.